Hello, everybody. Welcome to the MetLife and BFA and OPTIX webinar called Leapfrogging Microfinance Institutions into the Digital Age. We're going to wait one more minute for other people to join, and then we'll begin the webinar. Hello, welcome everybody to Leapfrogging Microfinance Institutions into the Digital Age, a webinar brought to you by MetLife and BFA and the OPTIX project. We're waiting for a couple more people to join, so please be patient, and in a minute we'll begin broadcasting the rest of the presentation. And as we wait for the rest of the panelists to join, I'm going to give you a few practical informations. The webinar will last approximately an hour. There will be 40 minutes of presentation and about 20 minutes of Q&A after the presentation is over. You can always post questions and comments through the chat or raise your hand if you have a question at any time during the webinar. And we'll do our best to respond to your questions during and at the end as well, during the dedicated time. You can see here on this box how it works. So you have the lower hand button, the chat and the Q&A button, and your audio settings as well. If you have any questions, feel free to chat them to us. Also, today's webinar is being recorded. There will be a link of the recording that we're going to share after the event today. All right, I think we can get started now. We have enough quorum in the room. So let me first introduce our egregious presenters of the day. We have with us Krishna Thakur, the East Asia Pacific Director of the MetLife Foundation. Krishna heads all the financial inclusion operations of MetLife Foundation, especially in the Asia region. Hi, Krishna, are you with us?
Melis, hello. Yes, I am. Thank you. I hope I'm audible.
Yes, you are. We can hear you loud and clear. And we also have with us Ashrul Amin, my colleague at BFA. He's a senior associate at BFA and also our specialist on data analytics and fintech for the OPTIX project and many other projects as well. Ash,
hello,
can you
everyone.
hear us?
Yep, I can hear you fine. Hello, everyone. Thanks for joining.
Fantastic. And for those who don't know me, I'm Maylise Carraro. I'm a senior associate at BFA as well, and I'm the program manager of the OPTIX project. Before we get started, we'd like to actually begin with a little polling question to get to know you better now. So I'm going to share with you a poll that should appear on your screen. And take a minute to fill it out, and I'll see your responses come live and then share the results with everybody. The poll is on now. Great. I see most of you have responded. There's a couple more answers trickling in. We're almost there. I see 21 responses out of 35. 60% is a good amount. I'll give it a couple more seconds. You won't be judged, by the way, by the answer you give. So. All right, so I'm going to share the results. It looks like we have in the room, most of us are actually consultants, but we also have a lot of financial institutions with us. We have 3 regulated banks and 4 microfinance institutions, 4 policymakers, very interesting, and also 8 other. I wonder who you are, but maybe we're going to have the chance to introduce each other afterwards if you didn't fall in any of these. And for all of you, we hope that the content of the presentation is going to be interesting for all the work that all of you are doing in this space with microfinance institutions or financial services providers in general. So let me now turn it to Krishna to tell you a bit more about what the OPTIX project is and why we are having this webinar today. Krishna, over to you.
Melis, thank you so much, and good morning, good afternoon, and good evening, everyone. Welcome to the first OPTIX webinar again on leapfrogging MFIs into the digital age. Given the audience here, I definitely don't need to tell you about the importance of technology and data for improving financial inclusion, which makes my job easier and quicker. So I'm less of a presenter. My job is to just take a couple of minutes to share a bit of a background about the OPTIX program in terms of why we are doing what we are doing. And Melis and Ash here will then follow it through with relevant details and specific learnings from the program, progress as well as challenges. We are very much looking forward to your comments, insights, and feedback as we discuss, as well as after the discussion. So OPTIX, in its expanded form, is optimizing performance through improved cross-sell. You could already see how creative the team is a multi-year program funded by MetLife Foundation and implemented by our partner, BFA, Bankable Frontier Associates. The program works directly with 4 financial institutions in Mexico, Colombia, Vietnam, and Bangladesh to optimize cross-selling strategies so that institutions can design and offer a wide range of targeted, affordable, and conveniently delivered products that low to moderate income customers can actively use and remain lifelong customers of the institution. Moving to the next slide, we work with 4 mid-tier financial institutions with strong social missions and flexible operations to test and refine pathways. We'll get to the term pathways in a while, to better cross-sell and product portfolios for clients. The institutions were chosen because they were large enough to have a meaningful impact, but small enough to be agile and respond quickly. It was clear that technology would be one of the pillars of transformation that would make these MFIs more efficient and customer-centric, and therefore enhance the ability to cross-sell. But digital transformations, as we all know, do not happen overnight, and one needs to weigh in the benefits for both the institution as well as the customers. So BFA worked closely with each of these financial service providers to assess the cost and benefits of digital solutions, specific digital solutions tailored to their needs, and experiment innovative approaches that could scale in the long run. In order to do this, the program followed a particular structure over the course of 3 years and is a very hands-on support program. BFA team began by analyzing the portfolios of these financial institutions to understand their products and channel performance better, which was followed by customer research to understand client behavior and deeper business case analysis. All of this led to develop what we call the pathways or strategies for better cross-sell, followed by design, prototyping, and testing these solutions. So I will now invite Melis to interacted with earlier, to tell you a bit more about this webinar and run us through some of the key lessons. And I look forward to an engaging discussion. Over to you, Melis.
Thank you, Krishna. Thanks so much for the introduction of the OPTIX project. So now I'm going to tell you exactly what this webinar is and is not, so we set expectations straight. So we are going to reflect today, as Krishna said, on 3 types of interventions that we have implemented with our partner institutions that made up 6 of the 20 pathways that Krishna was referring to across the 4 partners. What we don't want to do is offer yet another framework that financial institutions should follow to digitize or reap the benefits of technology in the digital age, because there's already plenty of those, as you can see from the images on the slide. So instead, we will focus on practical examples of how the OPTIX institutions have digitized and the challenges they faced along the way as they went through these transformations. And as you know, like any significant operational transformation, the use of digital technology presents both opportunities and challenges for financial service providers. And so we're going to dig a little bit more deeply into what that means really in practice. Because a lot is said in our space, but what does that look like exactly for the financial institutions? So this is actually a picture of Ash a few years ago, admiring the totally paper-based core banking system of an MFI. This was in part the situation, although not this extreme, I have to say, and some of our partners are actually in the line, so I wouldn't dare saying that, but in part it was their situation, and the situation in which we found our partner financial institutions at the very beginning of OPTIX 3 years ago. And as OPTIX went underway, it became clear that technology would be one of the pillars of transformation that will make these financial institutions more efficient and also more customer-centric. So in order to enhance cross-sell and operations in general, many of them wish to adopt a more digital approach. So we looked, for example, at their existing approaches and tried to understand how those could be enhanced via digital applications. So we looked, for instance, first at the loan origination process that often involves pages and pages and pages of paper. Second, we looked at the cash handling processes in the field and at the branch, which also often involves piles of cash. And third, we also looked at decision-making that happens internally with the data that they have on hand, which is not always comprehensive and can often err heavily on the side of anecdotes. And with those, we thought, all right, how can we exactly digitize these processes to make them more efficient by the introduction, for example, of DFAs, what we call digital field applications, to improve the loan origination process, or mobile money to improve the loan servicing and savings collection process, or what we call data analytics superpowers to improve the evidence-based decision-making of the institutions. And we're going now to look at these in detail, because one thing that it's often not talked about is the actual impact of these solutions, both on the institution and on the clients. So as we implemented this intervention, we always monitored the type of impact that they had. And we wanted to really understand, obviously, what the impact would be, because some naturally benefit more the institution than the clients, and others benefit the clients more than the institution. And that was part of our program design. So as you listen through the webinar, we'd like you to consider whether the OPTIX digital interventions actually serve the clients better or the institution. And at the end of the webinar, there will be another poll, so pay close attention. We're going to see if you followed the discussion. Here is our view of where each of the interventions actually fell in terms of the benefits to customers, institutions. But obviously note this is the assessment of our OPTIX partners and these OPTIX pathways, as we call them, and it could be different for other institutions in other places. For example, loan servicing through mobile money is high impact here for both, but digital field applications, loan origination is high for the institution and not so much for the client. But enough said in terms of setup. Let's actually dive into the details. Ash, I think we should start talking about digital field applications, because this is the most common first step towards digitization for the financial institutions.
Sure.
And we're going to start with actually telling them a story, which is the story of our partner CEP that developed digital field applications for the loan origination process. Can you give us a little bit more details on how that went and what the benefits were for the institution?
Sure. So CP, our Vietnamese partner, they developed a loan origination application that was shadowing. It ended up shadowing what they used to do on paper, and the benefits that accrued to them are the typical ones that seems to happen when you adopt such a system, right? So some of the benefits we saw were faster loan turnaround time because all the relevant information was already digitized, time savings for staff in terms of translating to increased productivity, in terms of caseload, cost savings from elimination of paper. They had more time to engage the client, not just on loan-related matters, but other things that CAP work with their clients. And of course, there was the promise to be able to use this data later on for future rounds, leading to faster approvals, but also the potential to use it for credit scoring down the road as well.
That's super interesting, Ash, and very true. And I think what's also important to mention here and surprising is that while these digital field applications were supposed to have obviously the biggest impact for the institution, they actually did have an impact on the client side as well. For example, they could increase convenience because the application process for a loan is now much faster and there are fewer paper documents required for KYC, for example, know your customer requirements on the clients, for the clients. And it can also mean that it's easier for clients to access credit. As you said, this can be used for better credit scoring. And so that usually makes the process of loan approval more automatic and quicker. And it's also important to note, I think, that the other very important client of these processes are actually, and interventions are actually the internal staff members of the institutions, not just the client, the end customers of the microfinance institutions. And this is an important point that came through the experience of our Mexican partner, Acremex. Here in the screen, you're seeing the wireframes that we designed to redo their loan application system. And they had actually already developed one loan origination app, but they did it without involving the loan officers in the process at first. And this ended up it was an off-the-shelf solution that ended up not working for the loan officers because it wasn't really suiting their needs, nor the product needs of the institutions overall. So we worked with them to develop a second version where we co-designed the features and the functionalities directly with the loan officers, adopting many user experience and user interface design principles, or what in this space we call the UI UX approaches. And the key lesson here really was, first, don't choose a platform before figuring out what is needed. And second, a participatory UI UX process and design process yields a tool that actually staff like and are more likely to use and therefore benefit from in the long run. And this is not the only institution where we had this lesson learned. Ash, can you tell us a little bit more also about our experience with Sajida?
Sure. So taking that segue off of the staff being such an important constituent of product design, Sajida the Bangladeshi partner, did an excellent job in terms of completely revamping the loan origination process, where you had an app to go and collect the information in the field, but then also a pretty robust assessment system and origination sort of permissioning system that happens on the dashboard throughout the branches, etc. Now, what was interesting was the element or the angle of the staff is also reinforced in a way that perhaps we are not expecting as much, maybe, in the sense that we found it was a situation where, it's easy to take a horse to water, but very difficult to make it drink if it doesn't want to, right? So from the point of view of the staff, they were connecting a lot of numbers before that you see on the screen, but not very reliably. The area and regional manager, they had to go to the branches because that's where most of the physical files were. And now with all of this designed, you would think the system would be so much more streamlined and robust, which it was to a very large extent. The structured digital form allowed standard data collection. You had creditworthiness, information not provided until all the information was submitted to remove bias. But the interesting thing was that a fair few of the pilot staff actually transferred a lot of their not so optimal paper habits to the digital platform during the 1-month phase-in period, right? So we studied how they were collecting information on sales, cost of goods, stock of goods, all those figures, how they were cataloging it before, and we found that a lot of those practices were actually being transferred into this platform because there was that phase-in period to do so. And then there were even situations where the process wouldn't start until the loan officer had sort of on principle decided that they were actually going to give this individual a loan, which also mimicked somewhat of the paper processes. So I think for the next cohort, what's going to happen is that it's going to be more of a ripping of the Band-Aid approach, along with more proactive corrective action when the applications are subpar. So either going in for retraining or essentially rejecting the application and starting it again. But that's sort of the motivation behind saying, you know, you can take a horse to water, but you can't make them drink, because you can take the paper away from the loan officers, but the paper-oriented behaviors are harder to remove.
Absolutely. That's a great say, Ash. And I think the other aspect of these applications, though, that it's important to remember is that digital field applications are actually not just for credits, but those behaviors are not any easier to install and convince staff to use with savings either. But it is for savings too, not just for credits. So with Sajida and CP, our Bangladeshi and our Vietnamese partners, we developed what we call a financial service advisory app. And the purpose of this app is to guide the field officers in their conversations with clients on savings by utilizing clear goals for mental mapping. So the benefits for the clients here are obvious and numerous. The conversation around tangible goals makes savings more sticky for the clients and helps them visualize what they're going to save towards. And this generally helps clients save higher amounts overall. So as you see, for example, here on the left screen, these icons all represent a specific goal. So you have education, you have childcare, travel, that could be vacation or livestock, or anything that could really help the client visualize what they're going to save for, and therefore commit to stick to the savings amount they want to put towards that goal. And from an institution perspective, I'm curious, what has been your experience, Ash?
Well, from the institutional perspective, you know, the financial advisory services app certainly allowed them to be deliberate about how they think about savings, right? So FSPs, financial service providers, generally tend to see savings as a bit of an amorphous mass of funds that are mobilized on the side while credit operations take center stage, right? Because the perspective is that very often, you know, savings accounts are have a negative bottom line. There is no good business case. It is a good source of funds, but often also provided as a social service, if you like, from the business case point of view, but also because there's a lack of recognition of what might make savings tick or stick for clients as well. So what an app like the FAS does is it allows the institution to have targeted conversations, especially around the longer term deposit accounts, mobilize amounts, which are of course good for the client in terms of building a meaningful lump sum, but also for the institution because you're closer to, if not at, break even, right? So in this slide, for example, we see two specific changes on top of the targeted sort of goal mapping that Melis talked about that leads to mental mapping. That can also be done. So on the left-hand side, you see how you can target the clients who you think are going to be good savers, because you can look at their current savings levels, their previous savings patterns, the period for which the funds have not been withdrawn, and then you can make a guess on who the best chances are who will open term deposits more. And then on the second hand, on the right-hand side, you have this notion of maybe income generation is not the only spiel or narrative that would that clients would connect with. You can come up with something where they need to get to a goal, and the FI or the FSP can be a partner to reach that goal, where they put maybe 8,000 taka in today, and with interest they withdraw the 10,000 taka in 3 years, which is what they need for their children's education that will be needed at that point, right? So the result of all of this was, you know, an elevation of balances, for example, from around a taka 3,000 or $40 level to something which was way north of 10,000 or 125. So easily a threefold increase over a couple of months period as this pilot sort of came in. which also happens to be higher than the break even for term deposits. So just going back to that point of, generally it was really gratifying for us to see digitization play a much bigger role in more effective savings mobilization, which is often not a focus amongst FSPs.
Absolutely. That's very true. And if I may, though, I'd like to take us, Ash, in a different direction now, looking at something a little bit more radical. Because we've talked about the more typical process of digitization of already internal processes of the microfinance institutions. But let's look now at what Sajida did, for example, which was more radical in the sense that they went full scale and developed a full digital product with digital disbursement and collection of a loan and made 5 of their branches completely cashless. So you're all familiar, I'm sure, with the concept of mobile money. So I won't spend too much time explaining this, but mobile money generally allows clients to pay installments digitally via their mobile wallets or via agents, agent networks in various countries. And it really increases the convenience from a client perspective because it allows clients now to make installments at any time during the day, so they no longer have to spend hours queuing up at the branches. And sometimes the branches close when they actually finish their workday, and so they need to postpone to the following day, and that just adds a lot of stress for the client experience. Now they can pay installments at any agent close to home instead of going to the group meeting, for example, or to the branch. They can stay longer hours at their business, which results in higher productivity, potentially higher revenue. So the opportunity cost is no longer there in terms of losing time at the business to deal with your financial matters at a bank branch. And for many clients, this also often is the first step into the digital financial services ecosystem. We actually interviewed clients a few months ago with Ash in the field in Bangladesh, and they all love the convenience of the mobile money loan, which is called Sojourn loan for Sajida, and the feeling that they also had access to modern, so to speak, I quote, services. It is important to note that most of Sajida's clients would not have a credit or a debit card, for example, these days. So this really gave them a sense of being able to access a service that is usually reserved for higher income customers. But for the institution, that's where the story gets tricky. What are the implications here, Ash? The good and the bad.
Sure. So let's see. You use the word radical, and that is certainly very appropriate in this case, right? So getting on mobile money rails for a brick and mortar MFI like Sajida is kind of like putting a Ferrari engine inside a Toyota Corolla, right? So we're all familiar with the images of group-based microfinance. It's a room of 15 and 30 very busy individuals throwing cash on a bed or a table. Loan officer collects it, signs a passbook, rushes out, goes to the next center. Goes from center to center until the day's collections are done, brings it all back to the branch office. Then it's all dumped on a table. The process repeats. The amount is counted. Dirty and counterfeit notes are separated. And then the residual is taken to a bank branch, at which point, you got to watch out for someone not snatching the purse away, so to speak. Now, picture a digital setup where none of this happens, right? There is no cash at all. The client shows up at an agent at a time and place convenient to them, as you described, and the back office processes essentially kick in, taking care of all the accounting. The accountant only has to step in for exception conditions, and the field officer can focus primarily on loan origination, delinquency follow-up, and other non-financial activities, right? So as a result, quality of life is very much improved from the institution's point of view. Cash handling costs are essentially eliminated. Staff are free to recruit and service more borrowers, again, increasing productivity. Monitoring audit costs, those are much lower. Back office is more efficient. And of course, there is the danger from actually carrying around all of this large amount of cash is reduced. So it's been almost a year now that Sajida's been doing it, and there are about 5 branches where more than 20,000 transactions happen through this bespoke system that was created by Sajida through the OPTIX project, and you have transactions of over more than $500,000 happening every month. So I think all of that is a testament to the success of this transformation of taking.
Sounds like a great story, Ash. Where's the trick?
Well, so the catch is, right, at the end of the day, you have to ask, so what happens to the groups? Because one of the primary functions of the group is, groups have been central to effective microfinance around the world. And collection activities have been central to the groups. So if you go digital this way, are you making groups obsolete? Or will the groups not having groups completely blow up the digital microfinance sort of scene? So in the spirit of experimentation, Sajida essentially decided to do away with groups in one pilot branch and find out what happens, right? So no groups whatsoever. We have a whole blog in this on Next Billion, but the impact was pretty profound. The field officers felt they were no longer in touch with clients. They couldn't get a character reference. They found recruitment difficult. Chasing down delinquent borrowers slightly more difficult. And new field officers had the hardest time locating his or her clients. So, of course, in subsequent pilot branches, the groups remained and continued to do all the non-cash activities, including statements, sharing statements with clients. And the one initial experimental branch had group meetings phased back in. Now, the other catch is, of course, the business case, right? Now, this is a little particular to Bangladesh, but the way it works, the business case is not a slam dunk, given the way the fee structure is. And this really only works if you can't reduce it by reducing staff members. You basically have to increase the portfolio. And then there's also the interesting element of all of this is set up as OTC or over-the-counter transactions because this was done from a client ease point of view, right? Because it was unreasonable to ask non-habitual mobile money users to top up their mobile money wallets just to make payments. But we do realize that this might actually delay their entry into a fully digital ecosystem precisely because of the lack of that wallet. So there are quite a few kinks that we're still working through.
Do you expect that we'll have more consolidated results about the business case and the effects on group cohesion by the end of the year?
Yes, so those are two of the major focuses, right? So in terms of the business case, there is actually a study that is essentially completing now, of which there'll be a public-facing version soon, which puts precise numbers based off of the income expenditure statements from all of these 5 branches over the last 6 months. So it's quite precise, and we will know exactly which direction it falls. And the result is essentially what we outlined above, which is reducing efforts doesn't really work. You have to expand the portfolio. And in terms of the groups, the research continues, but again, it's sort of, essentially going out and doing focus groups and IDIs to find out exactly what's going on.
Absolutely. So everybody stay tuned for more as we figure out the implications from a business perspective of trying to develop fully digital products. Now, it's one thing to design, specific interventions and specific digital products, but there are also more systemic interventions that we looked at, what we called superpowers, in terms of giving more tools for the microfinance institutions to do data analytics themselves. So there are things that technology allows institutions to do that can have wider implications for the entire business and strategic direction as well, right? So it's almost as if they have superpowers because to see and do beyond what was possible before, thanks to technology. So to illustrate this point, let us give you a before and after scenario with Ash. So imagine Ash is the loan officer and I am the client, and we're having a regular conversation, which could happen any day in our work.
Sure. So, Malise, thank you for taking the time to chat about. I see that you're interested about opening a term deposit product with us, in which you can put money away safely while earning greater returns. What can you tell me about why you'd like to open the term deposit account?
Sure. Yeah, I think I'm interested. I've been meaning to save up for my daughter's tuition. She's going to school soon, so I need those savings, and it's going to be very expensive. As you know, education is expensive, but I don't know how much.
Well, we're going to have to work on that first. So do you have a rough amount in mind, how much it would be, even if it's not precise, but also how long you might want to hold that money for?
Well, it's hard to say, but I think based on what I have now, I could put away 10,000 taka, and maybe for 2 years, 2-3 years max. I don't think I can do more on a regular basis.
Okay, well, that sounds great. I think, the interest rate for that period is about 7.5%. So while you put that money away, you're going to earn a decent amount of income on it as well over 2 years.
Really? Sounds excellent.
So, just staying on that slide a little bit still, but the interesting part is, that was a little contrived, right? But real conversations are probably going to have a few repeats of that. You will talk about the goal, but then there'll be a little bit of haggling about the amount, maybe the term, and maybe also, an understanding of how much interest is paid and whatnot. So real conversations are not that linear, but also we don't get to hear these real conversations, because what we see in the MIS system or the databases is essentially the end product of these conversations where people have decided on an amount. Now, not all conversations actually also result in an amount. So this is why we sort of look into all of this as a window into conversations not heard. And we ask, is there a way in which, we can actually sort of figure out what those conversations are happening, and it's just sort of be a fly on the wall, right? So it turns out we can do that because thanks to app usage data or telemetry data, you can actually track who is saying what, where, and when. And all the apps that are designed by the OPTIX program have all of that incorporated. So this allows us to reconstruct conversations that happen with the FAS app, for example. And the result is sort of what you see here, right? So just going through, these are only some of the things, but just to give you a flavor of what's going on the top left, for example, we see validation of a lot of the saving goals. We came up with these through focus groups and extended study of literature and all of that, and our experience in Bangladesh and other markets. But generally, it's nice to see that a lot of them have resonance with the clients. Now, maybe one or two of them don't, so livestock might be phased out in the next iteration of this product. On the right-hand side, for example, you also see this combination of the actual savings amount that is being discussed and also the term for which it is being discussed, right? Now, this is interesting because it lets us say things like, when we are talking about savings for children, we're probably talking about 50,000 taka, which is about $600 for about 3.5 years. That's what people generally plan for, or seem to want to talk about planning for. Whereas if you're talking about migration abroad, the amount is larger, 75,000 taka-ish, but the period is shorter, 2.5 years. And this gives us all kinds of information in terms of trainings, how to structure conversation, product messaging, and even design if we wanted to create a product particularly for this, right? So all of this is also, in general, really then allowing us to be a fly on the wall and get a sense of the conversations that we would otherwise miss. Of course, we also have to cover the basics, make sure that the who, the where, and the when, all of those are done. So on the top left, you can see all the pages that the field officers ended up with at most. The green ones are the savings-oriented ones. The blue ones are not. There's some interesting conclusions to draw from that in terms of the utility of the app as a monitoring tool. On the bottom left, you can see how long the longest conversations took, and you can drill into those and see what those actually had. And on the right, you can see the conversations, where they happened and when, right? Because all of this is important because when the app was designed, there were certain assumptions in mind. Now, these assumptions were evidence-based, but it's impossible to totally capture the creativity of human beings when these apps are released into the wild. So anyway, at the end of the day, the telemetry data or usage analytics allows us to, on the one hand, take corrective action through training when needed, and on the other hand, iterate on the product where positive creativity is involved. So yeah, I mean, talk about packing a punch into an app that is designed to facilitate savings conversations, right? But back to you,
Right.
Melise.
That's great, Ash. And I'd be keen to hear more stories of what you found out about the loan officer's behavior by looking at the usage analytics behind the applications.
Stuff.
Sure, there's a lot of interesting things. Now, it is really as if the app was given these invisible superpowers in terms of controlling what staff does, for instance, to the institutions. But sometimes you cannot have all the superpowers alone, right? And so some institutions have decided to opt for partnerships with strategic players instead of building solutions by themselves that could bring that missing digital capacity in-house. For instance, our Colombian partner, Banco W, forged a partnership with a fintech startup called Juntos Finanzas, which essentially offers a two-way messaging platform to create trusting relationships between the financial service provider and their customers, leading to obviously increase in retention, potentially also increase sense of support by the clients, and a general overall improvement in the customer service and the personal touch the institution provides to the customers. So these conversations are messages that happen automatically via a chatbot between the customer via SMS and the institution, and they're anchored on topics that the clients really care about. So the clients can ask questions on anything, whether they've lost their password or if they want to know more about a product or any general question. And automatically the intelligent chatbot system will be able to answer and meanwhile also learn more about the customers themselves. Then Juntos also offer analysis of these text messages and consumer replies, leading to also very interesting data for the institutions. So for clients, speaking again on how this benefits the customers themselves, this can mean that they feel more supported, they can provide feedback directly, as I just said, to their financial service provider and in lower time without, again, having to move and go to their advisor at the branch. And it also allows them to potentially build up a higher savings balance because most of these conversations are usually anchored around promoting account usage and also increasing the overall savings balances of the customers. There's, of course, benefits also on the institution side. Ash, what are your opinions on that?
Well, so there's of course the direct benefit of higher savings being mobilized, right? The whole sort of point or the main, one of the main reasons for doing this thing. But then there are the other benefits around improved customer engagement through targeted messaging, better understanding of customer behavior and preferences, and we hope that this all potentially translates to increased retention among clients, and so a higher customer lifetime value. And in an interesting kind of way, if Banco W is Batman, then Juntos has really been a great Robin for them, enabling them to achieve levels of client engagement that I just don't think would have been possible without this partnership.
That's very true.
So,
curious to see where they head on their Batmobile.
Totally. Well, it looks like it's getting to time when we have to wrap up. So let's go to the parting thoughts. We talked a lot about technology, right? We started with pretty widespread digital field applications that complement existing processes. Then we went to the somewhat radical use of mobile money that upends the traditional group structure. And then we ended with analytics that is really a generation ahead of what was there before. But I suppose the thought I want to leave you with is, in some ways the tech is easy, right? The tech is easy because if you can get the right people in a room, they can crank up through the APIs and the code and put a solution together. Sometimes the more difficult thing is getting around the qualitative or the policy-related questions around the deployment of tech, which can be its own whole webinar. But we want to leave you with a taste of what some of the things that we grappled with as we went through these different transformations are. And there are 7 questions here, which is a sampling. We touched on the first 3 to some extent, right? So the question around social cohesion on group-based microcredit models when they go digital. The impact of apps, will they erode the value judgment of loan officers? That is crucial during the loan due diligence process because everything is now so mechanical. Is the business case sustainable or not? But then you also have a whole bunch of other stuff that come into play when, for example, you're using digital credit scoring, for example. How do you make the algorithm accountable so that it is not introducing bias or exclusion, especially amongst marginalized groups? What are the privacy implications of knowing the exact location of either a client's home or where a staff member is? What are the full disclosure rules, right, around behavioral nudges that we have built into a product because we want a client to do one thing or another? And of course, something that is happening more and more, how does one guard itself against snake oil salesmen, right? There are a lot of solutions being thrown out there, but most of them are great, but we have come across some which are less than savory. So a lot of things to ponder, but maybe for another time. So on that note, let me hand it back to Melis.
Thank you, Ash. And as I said in the beginning, I wasn't going to leave you off the hook with the last poll question before we wrap up and open to questions from the audience. So these are the two questions. Thinking back on the examples that we presented, which solution do you think has the biggest impact for the institution, and which one do you think has the biggest impact for the client? So let me pull up, I'll give you a second to think, and let me pull up the poll. There you go, you should see it now. I'll give you a few seconds to answer, if you can remember all the solutions that were presented. Great, you're all paying close attention. And as some of you already voted, we can open it up for questions as well. So some we're going to answer some directly on the Q&A box, and some we're going to answer live. Okay, I see a question from Crystal Yan. Don't hesitate, the others, to ask more. And I think all answers have almost come in as well. So I'm going to end the poll now. Thank you. There you go. These were your answers. So most of you thought that loan origination applications were really the solutions that benefit institutions the most. Very interesting. But almost equal tie with data analytics superpowers via telemetry and mobile money. Very interesting, Ash, right? It sounds like all of these technologies obviously have benefits. So it's a bit unfair to try to weigh them in terms of the higher benefits on one side or the other. But yeah, I would agree. These three seem to be the most obvious. And then on the client side, also the mobile money disbursement and collection. I have to say the convenience of that, it's hard to beat. Would you agree, Ash?
Totally. I think the other thing that's interesting here is going back to the slide where we're trying to chart benefit to client versus FSP. In an ideal world, we would like it to be equally beneficial to both, right? But I think what we all recognize is that it often falls into a either or, and then what are the decisions that go into making those choices, because sometimes it's also very context specific. That also shows up here. So the solutions that are good for the institutions may not always turn out to have the most impact for the clients and vice versa. So very interesting. Thanks for sharing your thoughts on this.
Excellent. And Ash, we have a question from one of the participants, from Richard. He asks, and as FSPs move into digital, what is the biggest mistake they can make at the start? How can these be avoided? Any thoughts on this?
So one that comes to mind is preparation, right? There is a sense that, let's just go out there and get it off-the-shelf software, or maybe listen to a pitch and let's just go all in and see how this happens. And very often it's a matter of time and money and things like that. It just so happens that the lower income market segment is idiosyncratic, and these institutions are not run-of-the-mill financial institutions that maybe the service provider is serving elsewhere. So it is super important to kind of take the time and make sure that these solutions are client appropriate, these solutions are institution appropriate, but going back to something, Melis, that you mentioned, that they're staff appropriate, right? Because the staff themselves have their own interesting sort of setup and idiosyncrasies. So I would say the most important thing is not putting enough time into preparation and planning and jumping with both feet first into some kind of solution. Would you add anything to that?
No, I think you said it really well. There is, though, another interesting question that came through that goes back to one of the parting thoughts you shared about the need for scoring models. If you do make algorithmic, we need to make them algorithmically accountable, to prevent bias and exclusion among clients. What do you mean about that, and what's the risk of not having an accountable credit scoring model?
Sure. So let's maybe take a step back and look at what some of these models look like, right? in the good old days, well, even now, so one of the most powerful techniques for predictions is logistic regressions, for example. And when you do that, it's clear what the impact is. So we can say if you are male or female or self-employed or not, we know exactly what the correlation is, more or less what the correlation is with whatever outcome we're measuring. And so we can be careful that we're not biasing against any particular factor. But the problem with a lot of the techniques coming out now are they're black boxes. We just don't know just how they operate. We don't know which variable goes in where. And so we just have to take it on faith based off of some accuracy metric or something that, you know, when you put in a score, when you put in the parameters of an individual or a product or an account, on the other side comes out some probability of default and we have to run with it. This is clearly not always very good if you want to make sure that you're not introducing bias. Now, one solution is not to introduce variables that you know, could provide discrimination, such as gender or age or something else. But then your model is then suboptimal, right? So algorithmic accountability essentially tries to approximate some kind of you know, tries to get close to these black boxes actually saying how they came up with their decisions and then accounting for those or correcting for those. So there's a whole body of work, for example, which makes sure that you have fairness in a machine learning algorithm, which may not necessarily map one-to-one with accuracy or in terms of, you know, most optimal solution when it comes to machine learning, but it does make sure that your outcomes are fair. So one example of that would be that equal numbers of people in any given subgroup get a loan, right? The true positive ratio. So things like that, essentially.
Right. And Ash, I think we actually see this not just with financial institutions developing their own algorithms, but also with a lot of the fintech players these days. So it's something that applies to many players in many applications of machine learning, for example.
Absolutely.
There's another question also from Crystal. She asks, to what extent our team has done behavioral design experiments to encourage savings? Very good question, Crystal. And we have experimented with behavioral design with some of the institutions. For example, one of the products that we haven't talked much about today, but it's the long-term savings product that, for example, Sajida developed. And what we realized there is that there were a lot of issues around anchoring the client to a lower savings amount than necessary, because in the pitch that loan officers were using, they were always mentioning a standard amount that was actually too low, even for the business case of the savings product to be valid. So what we did there is trying to experiment with anchoring to a higher amount. So always in the pitch, you know, the amount that will be mentioned first was around, you know, 10,000 taka, for example. And that really worked in helping the client be anchored to the higher amount, or using, for example, the concept of nearness to goal, encouraging them to see a goal that needed to be reached and little by little getting there, or even social influence. So your neighbor is doing this, why don't you also save this much? You know, it's actually possible, others are doing it. So we experimented that with the staff. And we're also now working with Acremex in Mexico to actually develop behavioral experiments via marketing materials, for instance, or in the actual product design, leveraging these the behavioral principles and helping clients transition from a normal, you know, flexible savings account to a longer term investment account, for example, or just in general save more. And there's a lot that can be done with behavioral science in this regard. Ash, would you add anything?
No, I mean, there are all these little nuggets of behavioral design. So there's the mental mapping that you mentioned earlier. There is, you know, a version of loss aversion when it comes to sharing goals that you're trying to work towards, etc. So yeah, it's actually a rich sort of area in which you can inject all these little nudges here and there, and you can get pretty good results out of them.
Absolutely. So we're going to share the results of those experiments at the end of the year. They're just started with Acremex. So we don't know yet if they're going to be successful at actually increasing the savings balances and retain customers. But stay tuned for more at the end of the year. Let's see, we have, I think, another question by Sahana. She asks, what can we do to increase the funding opportunity for MFIs who want to implement these digitization projects, which are often investment heavy and take their time to show long-term results? Very true. We feel your pain. Well, I don't think there's a clear-cut answer here in terms of increase the funding opportunities. But there are programs funded by philanthropic capital. For example, the example of OPTIX is one of those, where there's an interest of the party to actually support microfinance institution towards their digitalization journeys. And the intended purpose initially wasn't actually, in our case, to work specifically on improving the technology, but it was to improve cross-sell strategies. And a way to get that, a pathway to that enhanced cross-sell, was to work on digital tools and digitizing operations. So there are other programs, for example, that I know of, also funded by donors or DFIs, development financial institutions, that are trying to support financial institutions in emerging markets to digitize. But often it needs to also come from advocacy from within. So at the board level, it needs to see this as a strategic direction and opportunity, and leverage also the board and other previous investors and partners to leverage funding for this. But there isn't one clear answer.
Yeah,
Ash, any thoughts?
Sort of tangentially almost, but one of the reasons, well, there were two bedrock principles for OPTIX, right? One was that it had to be evidence driven, but the other one was that it would have to make sense for the institution to fund it on their own, assuming that the pilot succeeded. So all the interventions that we did, none of them are actually particularly high ticket, right? They're certainly all less than, say, $100,000 US, and some much less than that. Now, even that can be a significant sort of investment, but it's one of those things where it's the kind of thing, once you go over the hump, the business case kind of speaks for itself, right? So that is something to keep in mind. But yeah, it's not an easy sort of situation.
Great, thank you, Ash. I think there are no more questions, so we can perhaps wrap it up.
Mali, sorry, in the Zoom webinar chat, there was a question around more of a macro level question, which was, may I ask whether the poor or less developed countries more attention or support from the government will give the development of microfinance institutions? Or essentially whether the government will give more support to developing of microfinance institutions. Melissa, I don't know if you want to take that.
It looks like the question comes from China. So I think, again, this is country specific. Mm-hmm. So it depends on each country development agenda and what they think of the role of microfinance institutions. There is a tendency these days to see maybe a diminished role of microfinance institutions, which I personally disagree with. But again, it's very country specific. I don't think we can generalize.
Right, pretty much.
So thank you everybody for joining the webinar today. We were very thrilled to have you with us, and you can follow more of our work on our website, which you could see on the previous slide. Let me go back, as well as our Twitter account and our Medium blog. So stay tuned for more. We're going to share more lessons learned and insights as we wrap up the program at the end of the year. And thank you, Ash, for joining, and thank you, Krishna, as well, for the introduction.
Yep. Thanks, everyone. Thanks, Melis.
Bye, everybody.
Thank you, everyone. Bye-bye.